All right, version 2. Now, in the previous video, we went through the slides. We talked about focusing on a company that we know, we like, we understand. We look at its peer group. We look at all the different metrics that we've gone through, right? I don't want to rehash the entire previous video, but this is where we left off. Now, from here, I really think this is a great time to go to the charts. So let's do that. All right, so here we are. We're looking at Ford. We've got a weekly chart and a monthly chart. And the argument could be made that Ford really hasn't gone anywhere since, well, 2009. We had some issue during COVID, but yeah, so did a lot of other companies. And if we knock some of that off of there, we had an average low of around $8.50 and an average high of around $18. That's not bad. That's a little more than 50% back and forth. Missed a great opportunity to pick this up for $4. And thankfully, we avoided buying it at $26. Now, suppose we were looking at this and we were thinking about getting into a covered call strategy or a wheel strategy. Here's a daily chart. On the year, by the way, right? This is a year-to-date daily chart. So the low on the year is around $11. Right now, I could buy it for $15.47. I could just, put out the cash, own it, $15.47. Would I want to do that? We're not near an earnings. So we had an earnings. It was reasonably decent. We moved to the upside. Their earnings has been increasing, right? We can see their earnings here was 26 cents. And then here it was 38 cents. And then here it was 68 cents. So increasing earnings. The earnings didn't help in the earlier part of the year when most of the market was going down, the S&P, the NASDAQ, right? Most of the market was going down during that time period. So it didn't really help there. At this earnings, we seem to have a significant change in market sentiment, and we've started setting higher highs and higher lows. We're above the 50. We were above the 20. We're back below that, but things are really turning around in this company. I've already gone through all the other metrics to decide this is a good company, right? So let's go. Well, you know what? Let's just stay here for a minute. Let's go out to the weekly on a higher time frame, not just a 1-year weekly, but a couple of years. And what we're looking for is anything that really stands out that's concerning. I'm going to avoid the whole COVID thing because I don't find that concerning. A little bit that gets my attention is how uniform this move looks. That usually is what you would see when the algos are trading. Very clean, very consistent, very organized price action. Nature's not random. Random walk is random walk, and this is not random. When it's not random, it's heavily influenced by the algos. Now, that doesn't mean good or bad, just if we had a subscription to something like Investors Business Daily with Market Watch, we could go in and ask the question, how many institutions own this now after that last earnings compared to how many institutions owned it, say, a year ago? And I think what we would find is there was a couple of institutions that exited their position out of this. And that's fine for me. For this, I'm already committed. But if I was looking at a company I didn't know and I hadn't done a deep dive on yet, I'd be a little concerned about that uniform shape. Now, I'm looking for anything that concerns me, anything that we've gone through in that previous video, and maybe some examples of what I don't want to see. Would be something like this, perhaps. This is GameStop. We were moving along. Everything was fine. There was no real issues here. and then suddenly it just went parabolic. It just went crazy. Big sweeping moves all over the place. Or AMC. This is trash. Or something like this. This is New Age InBev, and it's just continued to take a beat down. Or PayPal, Meta. These names just got slashed and hacked and beat down so badly that if I'm looking for a turnaround company, it wouldn't be that. So I want to avoid this kind of stuff, right? These big, sweeping, dropping holes with no explanation for the why behind it. At the same time, I'm looking for, and depending on your platform, you might not have it, but I'm looking for consistent earnings. I want to see things getting better and better and better, right? We can see down at the bottom each quarter where it had earnings, and I want to see that it's getting better. If it stays the same, okay, I mean, maybe that's fine. That's just the start of the conversation, right? We want to know a little bit more than that. And just like we were talking about earlier, look at the growth of the company. Is it stable? Here's Target since 2008. And you can see for a long, long time, Target had this defined range. And even the lows down here, well, that was the 07, 08 crisis, right? That financial crisis. When we came out of that, this was sitting in a consistent range, somewhere between $40 and $80. And then things really changed in the last few years. But look at something like Apple. Now, trying to compare a lot of companies to something that looks like Apple is going to leave you really disappointed in a lot of other companies. There are 600 companies that have weekly options. And while I haven't mentioned that it needs to have weekly options, I have mentioned that a company needs to have liquid options. And I believe what you're going to find is that if it doesn't have weeklies, it's really unlikely to have good options. Out of those 600 names that have weeklies, a lot of them aren't companies at all. They are sector names or they're ETFs, indexes, and that's not a bad way to go either. I didn't cover it in the first video, but if you wanted to approach something like, say, healthcare, getting into an ETF, selling options on it, getting your cost basis down to zero, this is not a sector that's going to go to zero. The government has a large pool of money in the health sector, right? When you think about it. And we've got an aging demographic in America that's going to need healthcare. It's not going away. It's not reducing. So as a sector, it's boring, it's slow moving, but that's not necessarily a bad thing. Let's go into the trade tab. Now I've got this set to where I'm hiding weekly options. So I'm going to undo that. That just shows more options strikes, more series. We can see the beta isn't even a 1. We do have dividend, and it's around 50 cents a share. It's not amazing. We've got a very small or a low implied volatility rank. It's okay, right? Yeah. And if we were to focus on selling these options, the bid ask is kind of wide. This isn't like a picture of liquidity. This is not a shining example of wow liquidity, but it does have participation. So we could try to work the order. We could try to focus on growth here. And there's a lot of money in these options. That's pretty impressive. So let's talk about this approach for a moment. Suppose that I came in and I sold the 130 puts, and we are 43 days to expiration. First, before I sell those puts, I want to already know, hey, am I going to hold that all the way to expiration? Nah, probably not. It's 43 days. But I'd probably be willing to hold it for 2/3 of that time, or even half that time. So we'll say 22 days. If I split the mid here and I got filled, say, 1375, excuse me, 375, and I've had the 130 strike, my average share price would be 130 minus whatever credit I collected. And just to do some easy math, we're going to say that I actually got it on the ask. And that's unrealistic, by the way, but it's easy numbers. So my average share price, if I was to be assigned at 130, would actually be 130 minus $4. And that's 126. Well, right now, the average share price, or the actual share price, is 129. So my buffer here, if I sell that 130, is that I really need the stock price to stay above 126, not 130. 130 would be my line in the sand if I'm concerned about assignment. I'm not concerned about assignment. Remember, I want the stock. My goal is to actually take possession of stock. So I'm not scared of the 130. But what happens if we get price falling below 126? Well, now I've got to make an adjustment, right? But until that happens, as long as it's staying above 126, I'm not losing money. Now, as soon as I sell that, I could just mark down in my book my average share price is 126. But since I know I'm not going to hold it to expiration, I'm not going to put it in the book yet. I want to wait until the transaction is completely done. Either I bought the put back and the trade is done, or I got assigned and I have the stock. Now, the cool thing is if you get assigned, all that credit's yours. So if you open the trade today and tomorrow you get assigned, which is really, really, really unrealistic, but just suppose it happened, you would get all that credit immediately. So that's yours to keep. In which case you did spend 130 per share for 100 shares. But because of the credit that you got, your average share price would be that 126. So when you're thinking about what option to trade, don't look at the strike that you're trading in a vacuum all by itself. Think about what that strike represents. The 130 represents $4 in this situation. So with 126 in mind, when I go back out to the stock price, I want to look at where that 126 is at. Oh, it's down inside this range. So as long as the market doesn't fall through this structure, I'm good. I need it to not come down here. And I know that price can, right? It can take a rejection on that 20, turn around and come back down, bounce off that level and move back up. Or it can come down, break that level, and keep right on going, right? We know that it can do that. But in this situation, I'm hiding behind this structure. I'm hiding behind that level, hoping that it would provide a little bit of support. Right? So that's one thing to really think about when you're trying to decide which strike am I going to trade. Now, another thing that you want to look at is the extrinsic value. Remember, you're selling these. You need them to decay so you can buy them back later on. The greatest amount of extrinsic value is right there. Those are the highest numbers. And you can see that the 130 is actually the highest number. It has more extrinsic value than all of the other strikes in this series. Oh, excuse me, the 129 does. These numbers are moving. Even though it's after hours, things are kind of moving around. So right now, the 129 has 335 in extrinsic value. That's the highest one. If I want this to decay for me to make money, then I want to sell the one that has the greatest amount of decay possibility, opportunity. It's a better word. If I'm scared of price and I decide that I'm going to sell an option way out here, sure, I can sell this option and I can get $2 for it. 209. I'm going to just continue to pretend that we could actually fill on the ask for a little bit. Sure, I could get 209, but that only has $1.85 of decay. And since it's way out of the money, I'm going to have to wait a long time. The rate of change on that is different than the rate of change at the money. And of course, price is going to move around too. So if our theory holds and price continues to go up, these 124s are going to fall even farther out of the money. And yeah, they're going to decay. But the greatest amount of decay is right there. And since we really want to subtract how much money we're going to get from our average share price, we don't have to fear that 130. We got to think about what our price is. So let's go back to Ford. So Ford underneath $17, but better than $14. That's a pretty decent range. It's $3. We'll come out to the October series and we'll look at those 17 strike puts. Now the stock price is $15.47 and I could sell this for $1.85. So let's get the old calculator out. First, what would our share price be? $17 minus, let's call it 185. Let's get on the bid. Our average share price would be $15.15. Well, right now the stock is $15.47. So I'm not very far off there. I could sell that 17 strike call, and even though that 17 strike put, and even though it is in the money right now, my fear or my risk is that price falls below 15.15 because that's where my real value is. The 16 and the 15 look pretty good. The 15 actually has the most extrinsic value out of the three, and it's 69 cents. So if we did that, we could take $15 minus 69 cents, and that's $14.31. That's more than $1 away from the current stock price. So let's go out and take a look at that for a moment. If we sold the 15 strike, then we need price to close above that 15 at expiration, or we're going to end up with stock. That's one aspect that we have to keep in mind. We'll end up with stock if price closes below that at expiration. But our average share price is $14.31. Huh. Normally I can, there it goes. All right, so way down here. So we can get assigned if price drops below that line, but we won't be in a losing trade as long as it stays above this line. And what if it does fall below that line? Well, that's still something that we can work with, right? Because now 14.31 would be my average share price. So let's just assume that Ford falls all the way down to $13 and I get assigned and my average share price is 14.31. Now what? Now we come in and we start selling covered calls. Well, which ones do I sell? I don't want to lose my stock for less money than what my stock cost is. And right now, my average stock cost is $14.31. I want to change that number. How do I do that? If I sold the greatest amount of extrinsic value, it would be those 15 strike calls. They have the greatest amount of extrinsic value. And it looks like I could sell them for around $1.17. I'll round up and say $1.18. So we want to take that 14.31 and we want to subtract that $1.18. Now my average share price is $13.13. So let's go back out to the stock chart. Now remember, I said price fell all the way to $13. And if I sell that call, that will give me more credit. Now my average share price is $13.13. I'm down because it's less than $13.13. It's at $13, but I'm not down by very much. And all I have to do is sell one more covered call, and I would have a lower share price than $13.13. Now, what's my risk of selling that 15 strike call when we're all the way down at $13? There is risk, but it would be low. And to be fair, I wouldn't get that much money selling a 15 if we fell all the way to 13. Right? I mean, just, to see what that would look like, let's go 2 strikes out of the money. What would I be selling it for? I'd probably end up getting around 17 cents if I was to sell a 15 strike call when price was sitting at $13. But if $13 was at the money, if that's where we were, I could sell a 13 strike call for around $1.18 or $1.20. So as you can see, the risk is there because price doesn't have to stop falling. It could just fall and fall and fall and fall. But price rarely moves in a straight line. And what we would be looking for is, can I sell enough options? Can I earn enough premium from selling options to outrun the pace of the drop? So if we're wrong and price is falling and falling, can we make enough premium from the selling of those options to outrun the pace of the fall? Sooner or later, it's going to base. It's going to quit falling and stabilize. It's going to find support. And when it does that, our options are not finding support. They're still decaying in value. We'll eventually be able to close them and sell another one. So what I generally do when I'm trying to decide which option do I want to sell, I look at what my average real value is in the shares that I have. I look at where the stock price really is, and I look at how much money I'm going to get for that particular option that I'm just getting ready to trade. And the reason I think a lot of people struggle with this is they're scared of price. So if we go to the put side for a moment, if I was going to open a trade today in Ford, I would very likely sell those 15s or those 16s because that's where the money is. And I would not be too overly concerned with the amount of money at risk. But let me throw you a wild card in here. What if I sold the 20s? I could get $455 if I sold those. Is it worth it? Well, for one thing, there's no extrinsic value in there, like it's 1 penny. So this will not decay the way you think. It's got time value, yes. Share value is how we'd say it. It's got share value. And if this option was to go out of the money at expiration, we would get all that credit because the option would go to zero. Otherwise, if I sell that $20 strike and I get $450 in credit, my average share price is $20 minus $450 or $455, and that would give me $15.45. Well, that's the current stock price. So trading this option deep in the money is like trading synthetic stock. And that's exactly what they call it, synthetic stock. So if that's my goal, then that's what I would want to do. And in that situation, I could be short stock or long stock. I can trade, synthetic options or synthetic stock on the call side or the put side. And perhaps that's just going to be something we cover in another video. All right, but I wanted to bring it up because I've had people say, well, if that's a lot of money, why don't I just sell that one? Well, there's nothing really to decay there. You're going to need this stock to actually do something for you to see any real value from that trade. But if you trade something that has time value to it, well, time will go by. Right, wrong, moves up, moves down in stock price, time is going to pass. And this option will decay from that time decay. Now, it might, decay $1 in time and then make $2 because price moved, but the option would still lose that time value. So I don't get too scared with which strike I'm trading at the money. I look at what that at the money strike really represents. And in this case, selling the 15 strike call, it represents about 65, 70 cents, which means my average share price is a lot lower than the current share price. And it gives me a buffer for winning and losing, not for assignment, but for winning and losing. And when I do get to the call side, I will have averaged in at a lower share cost than whatever strike it was that I got assigned at. So if I sell the 15s and Ford falls to $10, my average share price is $15 because that's what I bought it for at assignment. But because of that credit, I ended up getting it at $14 and say 30 cents. So now, if that was the situation, Ford stock is $10, my average share price is $14.30, I'd immediately start looking at the money calls, even if those are $10 calls. And I'd start asking the question, how much money will you give me if I sell that $10 call? And will it get my $14.30 average share cost below $10? If it won't, then I want to try to maybe go farther out in time so that I'm farther away from price. That way I've got a better opportunity or a better chance to see decay without actually taking directional risk. And or I would also want to go higher up in the options chain. So if price was at $10, then I would want to sell something like the 12 or the 13. That way I'm closer to that 14.30 average share price, and the combination of that credit with my average share price should get me lower than the $10 current share price. Now, I've mentioned before, there's so many ways to do a covered call strategy, and it's mainly because so many different investors have a different idea of what they want to do with that stock. Some don't want the stock, and some don't want to get rid of it. I had a coaching client who owned a lot of AT&T, and they got it because they worked at AT&T for years and years, and they didn't want to get rid of it, but they were still selling covered calls on it. Hey, I get it, right? It's not really performing as a stock. You might as well get more money for it, and you're selling options against it. Always keep track of what your average share price is. And remember, when it comes to defending these trades, rolling is most definitely on the table as a solution to being challenged. That you can roll these down the road, and it may not necessarily put you in a favorable position right this minute. But usually when we get challenged, it's because the stock made a surprise move. And what I found is that a lot of times a surprised move will work in your favor eventually because the volatility increases or decreases. And that offers you a chance to kick the can down the road, give things a little bit of time to stabilize, and they'll usually come options wise, they'll come back into your sphere, and you're able to roll one more time and fix a bad situation. But that's for this strategy, not for options in general. All right, guys. We're going to call it quits here on this video. And this is, other than maybe trying to show some examples of some rolls, this really is the sum of the concept. It is that simple. Always keep track of what your real average share price is, and then realize what you're going to gain from selling that option. And that your big fear is not assignment risk. It's not, your fear should not be, oh, I'm going to end up with stock, or, oh, I'm going to get rid of stock. I'm going to lose my stock. As long as you know what your average share price is, then you'll understand what your real risk is. It's the difference between where the stock price really is and where your average share price really is. That's your risk, not the assignment. If you have any questions, or you want to hear more about this, or you would like another video covering another aspect of this, hey, throw them down below in the chat. I appreciate your time, and I'll look to see you at the next video.